Hi, and welcome to an early global view on Thursday, October 29th. It's currently 7:45 a.m. U.S. Central Time, and we're coming to you a bit later than usual because we wanted to see this morning's first look at the U.S. third quarter GDP, and it was weaker than expected. Now, this is after the bump the markets got from a bit more hawkish sounding Fed. And was it really, or was it just so much talk? We're going to have more to say on that. And along with the Fed statement link that we're including, and that's our marked up version, where we're going to highlight what we think are the key features, meaning the Fed is still data dependent at present. So, we have to ask, what does all this mean to the markets? Well, hourly chart on the left, 30-minute chart on the right, U.S. December S&P 500 future. And right now that means that it is off $7.50 in pre-market trading back down to 2077. Now that's kind of important because the 2075 to 80 range was the next resistance after it pushed above 2058 to 60 on the gap higher on the People's Bank of China rate cut after the very accommodative ECB put it up through 2020 area and 2035 to 40. And you notice how, other than some slippage throughout the day on Tuesday, it back below 2060 to 58, it basically held there. And held there on the sharp initial sell-off, more or less, with some minor slippage yesterday after the FOMC statement. So what do we have now? We have a market that's been back down, in fact, this morning to 2073. And that's important because if we had to have a tolerance of slippage back below 2075 to 80 after it pushed up yesterday, it would be the old high of this range when it neared that area in the wake of that People's Bank of China rate cut at the top of the strong rally out of last Wednesday's week close into the ECB Thursday and on the PBOC rate cut Friday. Next resistance, if it holds, is up around the 2100 area with some higher resistance back around the old highs. We'll take a look at that on the intermediate term charts. But what is also very interesting today about whether it holds at 2075 to 80 is that the hourly MACD is back out over this upper runaway band, and the degree to which, and that was only reinvigorated, not during the early action yesterday, but during the late push up once the market had the sharp knee-jerk selling after the initial release of the Fed statement, which started to lean toward them hiking, but then if you really scratch below the surface, it showed where they're still pretty balanced. And that pretty much does it for the short-term view of the S&P 500.